Okay, I think we're broadcasting. This thing's looking pretty good. Let's look at this problem that I had to do the other day, this cash flow. And you know you're gonna have to do one on the test. And I probably will let you use a page of notes on the test, chapters 15, 16, and 17. And 16 will be easy for you if you practice these cash flows, the indirect method. Now we'll look at the direct method, but we'll look at it a lot less time and what have you. But this semester is marching on, and this is what, April the 10th. We got 3 weeks left in April, or a day left in 3 weeks, and then we got that first week of May, and it's over. Exams start there pretty soon too. We got lots to cover, so we'll have to target your third test for sometime next week. Uh, Put it off as long as I can, maybe to Thursday. Uh, Cole, I wish you'd still go ahead and pre-register, whether we get you back or not.
I'll look at your times.
Do what?
I'll look at the times on your report.
Oh, okay. All right. And the rest of you, no matter what your major in, try to get pre-registered. That way we can plan classes. I don't think you'll have to split, but anyhow, next year I don't see a lot of change. I guess we may have a dean. We got a part-time fill-in dean right now. And she used to be dean here a few years ago. She was dean for a couple of years. They used to swap it around. Dr. Bourne's been the dean, Dr. Sneed's been the dean. They passed it around there for a while. It boils down to nobody wants it. They usually want out. But anyway, look at this problem. This was exercise what? Is this exercise or a problem? The one you're looking at? Exercise what, 6 or
18?
or 18, way over there. All right, let me bring that up. See where I've got my solutions. How many of y'all have had the math quantitative techniques? Math, none of you have had that yet? Quantitative tech, yeah. Who's had that? Greg? Was it hard? Carson, was it hard? Molly? No, it was brought up at our division meeting yesterday, and I guess some of the advisors say their students found it too hard. They put it off to the seniors. Monique, what do you have in that course? Do you have a little bit of algebra or pre-calculus? What do you have in it?
Like sometimes you'll like it a little hard.
Depends on your background in math too. But I know a lot of 2 years of me, they just have a business math. And the finance professor said students had trouble with fractions, decimals, percents. Now, I taught sixth grade for 2 or 3 years, and in the sixth grade, we had decimals and fractions and percents. And any kind of bonehead math, that time they called it bonehead in high school, or business math or general math, you had fractions, decimals, percent. And he was talking about students didn't know that a ratio was a fraction. We practiced that on partnerships, like 1 to 2 to 3, and 1 6 2 6 3 6. But I think all of y'all know fractions, ratios, percents. Okay, but we have to have some math. Uh, Math makes you think. Okay, I put it off too. I took what was called bonehead math after Algebra 1. I got a D out of Algebra 1 because we had 2 lunch hours. And in the ninth grade, I just sat and watched the females go by during my class time because we had 2 lunch hours. And I did well in bonehead math, so I put pre-calculus. I had to have pre-calculus. So I put it off till I was I guess, a junior or senior, and I struggled. I got through it. But when I wanted an MBA degree, I had to have calculus, advanced calculus. And here I hadn't had calculus. I didn't have very good grades in pre-cal. So, but I took it. Had a Russian professor. Couldn't understand him a lot of times. But I got tutors. I got high school algebra books. I went through algebra 1 and 2 on my own. And I got a tutor. And I was determined to pass advanced calculus. And then state of Virginia certified me to teach math in the high school. And here I'd avoided all those years and and didn't want it. It ended up being certified in it because I'd had advanced calculus. Anyway, looking at this problem, I showed you bits and pieces of it. Net income is always there. Depreciation, you add. Does anybody remember why I said you add depreciation? Does anybody remember what I said about that?
You know,
All right, depreciation of 100,800 was taken out here. Well, why do we want to add it back to net income? Why do we want to add depreciation back? Now, you got the first part of the answer. What's the second part of the answer? Because you did not pay out cash for depreciation, depletion, or amortization. The short definition of cash flow is net income plus depreciation. That's the shortest definition you can find, net income plus depreciation. But we go further and gain on sale of investment. Why don't we subtract the that? Because we added it twice. We added it here and we added it down here under investing. So if we added it twice, we better take it out once. A loss would be a plus, a gain would be a minus. Okay, increase in accounts receivable is a minus. You're tying up your money in accounts receivable. We didn't get cash. You were tying up money in inventory. You spent cash. Increase in accounts payable. Somebody's loaning us money. When we owe accounts payable or taxes payable or wages payable, somebody's loaning me their money even for a short time. A decrease in accrued expenses, that's taxes, wages, whatever they may be. We paid some of them off, so cash went out. So operations. Now, that's the only one that's different on the direct method. Operations, the direct and indirect method are different, but financing is the same under both methods. All right, cash from sale of investment. All right, that gain of 17,280 is in here too. It was in net income and it's here. We've already counted double. Gotta take it out once. Cash, we bought land. Cash, we bought equipment. We got a big negative cash flow here. Now, is cash flow income? No. Does your checkbook match your income? No, because we're on the accrual method of accounting. People owe us money, we owe money. Financing. The third part, we sold stock, got money coming in. We paid dividends, money went out, 180,000. We can see 381 and 180 is a little more than the 451 negative. So we still have an increase in cash at the beginning of the year and cash at the end of the year. Okay? How many of you filed a tax return this year? How many of you hadn't filed a tax return? Tell them you didn't work anywhere? All right. Well, you should pull that average up to 4.0. I haven't filed my taxes yet, but I get a message on my answer machine. We have received your tax return and we have found fraud. This is the IRS. Please return this call to the IRS as soon as possible. It shows misconduct on your tax return. I don't know who else gets those calls, but right away I detected IRS don't operate that way. They sent me a letter that had me bring in proof of different things. So I tried to call that number back just for the heck of it. And it was in the evening, it says, this answer machine is not taking message. What does the IRS have to take a message? The IRS, you don't get an answer machine. They don't return your calls. So I called the number yesterday and I got somebody on the other line. They didn't answer IRS, they just answered. I said, I got a call from this number. Oh, you're in trouble with IRS. I said, look, I am 95 years old. I have not filed a tax return in 25 years, and they hung up on me. So the other people will probably get those. I don't call them telemarketers. I call them scam artists. I don't know what they wanted. They probably wanted a couple of $1,000 to get me out of trouble with IRS. And I hope nobody is foolish enough. But sometimes they prey on old people. The older people don't understand, and it scares them. They may get some money from scams like that. So beware of scams. They're out there. Okay, now if you had your balance sheet, good morning, Anthony. If you had your balance sheet, you would have these first three figures on your balance sheet. Cash on last year's end of the year balance sheet, cash on this year end of the balance sheet, and the difference would be your increase or decrease in cash. So that's a cash flow statement. All I want you to do is be able to do one. All right, and try to take out all the possible tricks. So what is your assignments today, Cole?
That was 183, 38.
I have totally skipped the direct method as of now. We need to look at it a little bit. All right, on page 808, statement of cash flow, indirect method. Now you got to do some subtracting yourself. Remember, take your cash up there, now subtract your cash. What is the difference? What's the difference? Looks like 5,000, increase or decrease? In cash, is that a 5,000 increase or decrease? All right, that's going to be your answer. And those three numbers there, beginning, ending, and the difference will be the last three items, numbers on your cash flow. All right. So take the difference in your accounts receivable and it increases. Is that a plus or a minus? If your accounts receivable increase, will it be a plus or a minus? Be a minus. Your inventories increase. Is that a plus or a minus? Minus, you're tying up money. Investments, it looks like you sold some investments. Is that a plus or a minus? Have to be a plus, wouldn't it? And how about land? Is that a plus or a minus? You went from nothing to $500,000. Would it be a plus or a minus, Cole? Definitely. Equipment. We went from $1.2 million to $1.4 million, and that's not even counting depreciation yet. And that's also a minus. Now, accumulated depreciation grew 100,000. So our equipment went up, not 200,000, but it went up 300,000. All right, now look at your payable. Your accounts payable went up 40,000. Is that a plus or a minus? Anybody? What do you think? Jonathan? Be a plus. You're borrowing somebody else's money. Accrued expenses payable went down 5,000. Monique, plus or minus? Definitely. And dividends payable went up from 25 to 30. Sydney, what do you think? A plus or a minus? Minus. Common stock went up from 600 to 700. Anthony? Looks like we sold some more common stock. Is that a plus or a minus?
Plus.
All right. And paid-in capital went up. That's also a plus. Now, retained earnings went up. How much? All right. Now, I want you to figure out your net income. Your net income, if you were doing a retained earnings statement, you'd take beginning retained earnings, you'd add net income, and you'd subtract dividends. So you can find your net income. Now we have a bunch of other things here. The investments were sold for $175,000. You had a gain. Equipment and land were acquired for cash, not a mortgage. There were no disposable equipment, no sales. The common stock was issued for cash, as usual. Well, you could issue it for equipment. There was $500,000 credit to retained earnings for net income. Well, $500,000 credit would have made that $1,450,000. Well, you got $1,360,000 left. That means you paid out dividends. There was $90,000 debit to retained earnings for cash dividends declared. You take dividends out of retained earnings, but declared does not mean you paid them. We're talking about cash. You can buy all the land and building you want and get a mortgage on them, but that's not cash. Cash is cash flow. This is the fourth official statement. It did not used to be, but a few years ago, all accountants, all book publishers, general accepted accounting principles, all decided that cash flow was the fourth statement. All right, now let's look at it. If you got those pluses and minuses right, there's no trouble with these statements. Net income, depreciation. Now it told you your investments were on your books for 100, you sold them for 175. So you minus a gain. Accounts receivable increased, minus. Inventories increased, minus. Accounts payable increased, plus. Decrease in accrued expenses, minus. So $490,000 is your cash flow from operating. Okay, Taylor, do you have this problem? Do you have this one?
Yeah.
What is your cash flow from financing?
Cash from common stock.
No, wait, let me back up. Investing.
Cash received from sale of investments was $175,000. Cash paid for purchase of land minus $500,000. Cash paid for purchase of equipment minus $200,000.
All right, that's it, except adding. And when you add them, a -5, a -2, and a plus 175 is a minus. All right, we got cash from operating. We got minus cash here. So a company needs to know where their cash comes from and where their cash is going to. Okay. Same as you as an individual, especially if you ever get married. Your cash goes to your wife. She spends it all, you know where it goes. Okay. All right. You can bring it in with a bulldozer. She'll take it out with a bigger one. Okay. Not necessarily now. Accounting majors sitting are conservative and yeah.
That's why we keep our own money and we just blow our hubby's stuff.
Do what?
That's why we keep our own money and we just blow our hubby's money.
There you go. All right. Positive attitude. You hoard up your money in case you get divorced. That's a positive attitude, isn't it? Okay. Gregory, do you have the financing part? Last part? Okay, anybody on that last part, what do we get cash from financing? How much? Anybody? All right, 40,000. We sold common stock and we paid dividends. Now, it says dividends declared 90,000. That was not cash. So you go up there and look at your dividends payable, and you had 25,000. Okay, and you declared how many? How much dividends did you declare? All right, add 90 to 25. Now you owe 115. All right, but you paid it all but 30. So I subtract 30 from 115, and what do you get? This is the cash we paid out for dividends. Be careful, and don't let that one trick you. 85,000. 25 plus 90 declared makes 115 minus the 30 that you still have owe means you paid 85. Any question on this one? All right. Now they have an optional sheet here. I usually don't push this optional sheet. You do it on spreadsheet. This is your three figures for cash. Here's your accounts receivable. Debit balance would be a minus. Inventory, debit balance, a minus, and so on. All right? That's optional. You do not have to do it. And any problems are on a test.
What did you say we could copy down for the next test in the book? Page 618.
Yeah, you can have that page plus a page of notes.
Oh, that's plus a page.
Yeah.
Oh, okay, I got you.
Yeah, that one page will be for the next chapter. It's ratios. And on a page of notes, if you want like this whole problem copied down on that page, you can. Yeah. A page of notes is a page of whatever you want to put on it. And some of you write small enough, you can put a lot of stuff on it. And if you got that chart for chapter 17 to do ratios, and you got this financial statement from this chapter, you got to go back and study the other chapter, take quite a few notes on investing in stocks or bonds, and you'll be okay on this next test. Okay, I do not like this optional method, but you can do it if you want to. Here, you got your net income, still add your depreciation as a debit, Your minuses are credits, and you're still going to come up with an increase in cash of 5, and you're beginning and ending cash. But of course, these have to balance. But I don't push this optional method. Now, where will you get cash flow again? All of you have to take finance. You'll have this statement in finance. Learn it now or learn it later. If you're accounting major, you'll get it in finance. You'll probably get it in managerial, possibly even cost. Maybe get it 2 or 3 more times, but at the same time. Well, what the course is called, this statement is still the same thing. So learn it now, learn it later. Right, the second problem, I don't see any tricks in it. Same old on net income, add depreciation. Didn't have any gains or losses. Decrease in accounts receivables a plus. Increase in inventories a minus. Increase in prepaid items is a minus. Increase in accounts payables a plus. And here we only bought equipment for $395,000 a minus. And here we did sell some common stock. Cash of $600,000. But we used $50,000 for dividends. Cash used to retire a mortgage notes payable. Now, under financing is common stock, is bonds, is long-term notes, and a mortgage is a long-term note. And your answer here is $80,000 cash at the end of the year. Increase in cash was a minus 20. You started with 100, now you've got 80. Now, if you're not going to have much cash left, you'll need to go get a line of credit at a bank. You've got to have cash to meet your payroll. You can't pay your payroll, you've got some morale problems at work. You know, if your payroll check is bad, how that make you feel? All right, how many of you got these last 3 answers to check out on this problem? 2 or 3. Sydney, did you get this problem?
No.
All right. So more people had number 1, less people had number 2. There'll be less people that has number 3. Okay. And number 3 is probably the one I'll take up for a bonus. All right, on number 3, we have a net loss. That's the new thing here. That's a minus. Depreciation is a plus. Loss on sale of land is a plus. Increase in receivables, minus. Inventories, minus. Decrease in prepaid, plus. Decrease in accounts payable, minus. So we've got a bunch of minuses here, and we did sell some land. And we did use cash for building, and we did use cash to purchase equipment. So far, we've got a lot of negative cash here. Operating, investing, and now let's look at financing. Should have some positive cash from financing. We issued bonds payable, we issued stock, we paid dividends. So we finally got a good plus here. Our difference here is a minus in cash. Cash at the beginning of the year, we still got pretty good cash at the end of the year, $918,000. Now you see these 3 are all the same. These 3 statements are all pretty much the same. This one, we finally had a loss to add. The other 2, one we had a gain to subtract. These flow the same thing about every problem, okay? right, if you have this one, today I'll take it. And here you had to look at those accounts. All right. Now, I'll take this 3 as a bonus. If you got it, I'll take it now. If you don't have it, I'm gonna give you an alternative. John, you didn't have it? 1 and 2. Well, at least one. All right, those that don't have it, if you want the bonus, then you will do you'll do both of these problems, not as homework, but hand them in Thursday for a bonus. This pen doesn't write good. It's 16 2B and 3B, and I've got this pen that has fuzz or something on it. All right, if you hand those in Thursday, now 2 people don't need to hand them in. That would be Monique and Co. All right, we're still going to go back and look at the direct method, but today we're going to start a new chapter. We're going to look at sum of 17, and let me find my PowerPoint.
Mr. Leslie, last day of registering 12 for Friday. It's 13.
What is Friday? The 13th?
14. So they said 13 is the last day.
Is it 13th?
Friday's the 13th.
And that's the last day to register, right? Well, Anthony, if you're having bad luck, you better register before Friday.
Oh, all right.
It's on the 13th. We could skip some of the terminology. Which way is horizontal? Which way is horizontal? Straight across. Which way is vertical? Up and down. Now, common size statements, horizontal, we compare across. 2016, 2017, 2018, we compare years. Vertical, we can take an income statement or a balance sheet and turn them all into percents. All right? And these are called common size statements themselves. All right, look at your first common size statement here. And we don't spend a lot of time on these. We spend it on the ratios. All right, this is horizontal, even if we compare 1 year to the next. Our current assets went up from 533 and 5 to 550 and 6. That's an increase of 17,000. Now, what do we divide that 17,000 by to get 3.2? Anybody, what do we divide this 17,000 by to get to 3.2? What is your base year? What year are you going from? 05, right? So here's your figures you divide by. These are your denominators. The increase or decrease is your numerator. Now, take your calculator, divide 17,000 by 533,000. I usually just leave off all the zeros and get the same answer. I divide 17 by 533. Does that give you 3.2 rounded? Which is decimal 0.3, decimal 0.32. So you change it to a percent. Now, what's our calculator gave you, Tony?
Zero.
Taylor? All right, that's a comparative balance sheet. Now, if you look down through here, which one would you notice being a big difference? Which one is a big difference? Here's a big change. You sold investments. Here's a big change. Long-term liabilities. You got rid of half of them. Your current liabilities also decreased. And of course, your stock retained earnings went up 30%. That's a good increase, isn't it? A 30% increase in retained earnings. So you want to notice these percent changes if you're a supervisor, a manager, an owner. Same thing now for an income statement. Year 5, we had $1.2 million. In year 6, $1,498,000. So we got 298 divided by 1.2. Our sales went up 24.8%. That's an important number. Our cost of goods sold went up higher though. It went up 27.2. Our gross profit is important. It went up. Naturally, your selling expenses are going to go up. They went up higher than your sales. Administrative expenses went up. Total operating expenses went up, but not as bad, not much as your sales. Now, other revenue went down. Not big dollar amounts though. Other expenses, 50%. Now, here's your main number right here. Your net income went up how much? From 76.5 to 91. Divide 14.5 by 76.5. You had a 19% increase in net income. These figures are important if you have a business. They're important if you have an accountant and have to run these for the owners or the stockholders. These are called common size statements. And both of these were horizontal. Retained earnings went up 37%. At the end of the year, 30%, that's a good increase. All right, now a vertical analysis. Vertical is up and down then, right? We change every figure on the 5 and the 6. Now, total assets is 100%. Divide 1,139,500 into 550. You're going to divide total asset total into each individual item. Total liabilities into each individual item. Total liabilities and equity into each individual item. What's important here? Here your assets was 48%, up from 43. See the change? Nothing changed that much. Retained earnings went up from 11 to 15.7. Not a big change. Now, owner might want to look at what percent of my assets are cash. Current assets. What percent is property, plant, and equipment? How much liabilities? Now, your liabilities is what percent? 27.2. And ownership is 72.8. Equity is ownership. Now, some businesses believe in this being 50-50. Finance as much as you invest. Invest $100,000 and finance $100,000. All right, that is called vertical analysis. All right, another income statement, vertical analysis. But now here, sales is 100%. Divide sales into everything below it and change everything into percent. Here we have net income went down from 6.4 down to 6.1. Went down or went up? Went down. All right, now here's where we get into, I'll get back to some of this other stuff later. I want us to do these three ratios. We're going to practice them as we go. Now, in your book, I want you to stay on page 829. Now, hopefully you have a calculator. If not, you can use your cell phones in class just on homework. Working capital. I'm going to give you these formulas as we go, and you're going to use that statement to answer this question. Is current assets minus current liabilities is equal to working capital. All right? Now you're going to do that by using the balance sheet on 829, and you're only going to do that for Y6. Y6. Your current ratio, I'm going to try to find a better pen, is equal to current assets over current liabilities. Now your quick ratio is current assets minus inventory. And let's see if they've got prepaid. We can't do this one because we don't have all the information. All right, so calculate those two real quick. Okay, what's your answer here, Co? Current assets minus current liabilities.
40.
You got what?
300.
40?
40,000.
Is that correct, Sydney?
Yes.
That's just current assets minus current liabilities. All right, now on your current ratio, you put current assets over current liabilities. Jonathan, what'd you get for that one? 2 point what?
62.
Times. All right, did you get that, Monique? So your current assets is 2.6 times your liabilities. That's a good thing. It should be over 2. The national norm, it's got to be over 2. You compare one industry to the same other company in the same industry. All right. So here's your working capital is equal to current liabilities minus current assets. That's a WC. I told you before that a WC means a water closet in some countries. WC may mean also Wayside Chapel. Okay? So look out for abbreviations. All right. Now, Cole, didn't you have 340,000?
I do.
All right. Now that was better than 05 at 290. Here was your formula. Here was your answer. Jonathan gave me 2.6. In 05, it was 2.2. 2.6 is better. Now, some of these ratios, bigger is better. Some of them smaller is better. Now, the quick ratio is your quick assets, cash and other current assets that can easily convert to cash. I don't think we had. Now, they broke this down. We could do it. We could take cash and temporary investment accounts receivable. You are leaving out prepaid items and inventory. And that should be bigger than 1. This company is 1.3. They were hurting back here. No, Jefferson's company is hurt. They've only got a 0.8. It should be 1 or bigger. Now that's your 3. All right. That is your 3 ratios that we start with in this chapter. So I'm going to have you to calculate those as we go along. We got a lot of them. We got a lot of practice to do. And remember, on page 848, you can have that copy. By hand, by pencil, by pen, or by copier. All right, go to exercise 17-3. This is on page 860 this time. Page 860, exercise 17-3B. These are just bonus questions. Take a minute and answer 17-3B, page 860. I'm going to see if I can get a better pen. Okay, this little exercise, current ratio. What does your current assets add up to be? Anybody on that one? What's your current assets? Jonathan, what does cash, market security, accounts receivable, and inventory, what does that add up to? All right, Anthony, what is your current liabilities? You only got one, don't you?
No, it's two. One security deal, asset and liability. They got marketable securities. That would be the asset.
Those first 3 are assets.
Wait, is inventory not an asset?
Inventory assets.
Yeah.
It's 4 of them.
All right, those first 4 are assets.
Yeah. So it's 6.
Now, you're still saying that's only 480 or is that
No,
something?
it's 600.
How much?
It's 600.
Even?
Yes.
And what is your current liabilities? But what is your ratio? 2 and 6 is what? 3. 3 times. You have 3 times as much current assets as your liability. Now, bankers use these ratios when they're going to lend you money for your business. Okay? Now, the quick ratio, which one do we leave out? That quick ratio, you got your quick assets over your current liabilities. We know 200,000 is your current liabilities. Which one do we leave out to do a quick ratio, sometimes called acid test? We leave out inventory. So we'll leave 160 out of this 600. What does that leave? Now that will leave, what will that leave? 440? And that's going to give you a 2.2. All right. Now, folks, ratios are easy. Ratios are easy. We're not going to make them hard. All right, accounts receivable analysis. We got to do accounts receivable turnover, number of days sales in receivable. All right, the accounts receivable turnover. Here's a simple formula. Now you're going to have this formula on that page that you copy. Sales over average accounts receivable. Well, how do you get average accounts receivable? Anybody? How do you get average accounts receivable? Beginning plus ending divided by 2. All right, here's your beginning plus ending divided by 2. Now you take sales minus or divided by average accounts receivable. Looks like you got 12.7 and over here 9.2. Which one is best, 12.7 or 9.2? Which one's the best? The bigger. Depends on how many times you collect your accounts receivable. If you collect your accounts receivable 12 times a year, you're collecting every month, about every 30 days. But if you're collecting 9.2, you're collecting about every 35 or 40 days. So let's look. Here you take your average accounts receivable divided by your average daily sales. Now let's go back here. I want you to divide 360 a rounded year, or you can do 365. Divide that by 12.7 and see what you get. 360 divided by 12.7. How much?
28.34.
Now that's the best way. That's the quickest way to get the answer. But let's look at their way. They take sales divided by 360, and they get average daily sales and divide it into average accounts receivable. And let's see what answer they got. They got 28 what? 0.6. But my shortcut method is just as good, but you got 28.4. You can use either one. All right. Now, is collecting your accounts receivable every 28 days better than every 39 days? Yeah, you want your money as soon as you can get it. All right. Um, all right, let's go to page 860 and do exercise 4. Do exercise 4 for practice. See if you can find the same thing we just found. As long as the color line for you at 2:30, yeah, both of them will come by. Once we get it done, Thursday. Here on Friday. How long does it take to get there? Yeah, how long does it take? Go down the road, Virginia side. That takes you, what, 8 minutes?
I mean, I've already made the schedule pretty much. Now I'm going into like today, after my second class.
When I say, these are right. I'm cold about it. See, the reason they did that, I had so many last year, they had to give some of them away. So, to me, ordinary, it doesn't matter, but yeah, I'd like to look at it and go ahead if it's needed, it's not.
But I have one more to add, but
I mean, you can add anything else you want to, but you can get manual accounting also if you want to.
it's all right.
The intermediate,
Oh,
but you're just gonna be a what, sophomore next year? Well, take it easy then, you take 2 accounting classes, don't add another accounting. Taxes not bad, intermediate is what it's called. Econ, it depends on how well we know how to do it with line. Want to come? You had econ?
oh yeah.
I would say right there, I'd say that's the code that burned out.
You're great.
What you what did you get out of econ 1?
Just a big amount. This year it's kind of dropped a little bit.
You got econ 2? Well, you'll be out of that, so you don't have to worry about that. I know he's got this method, you can't proceed unless you do. You can't do point B until you finish point A. If you put it off to the end of the semester, you got point A to Z to work out. Well, they may do it different. It says it starts out with 30 in econ, it's 7 or 8 passes. It says 15 of those 30 are gone, that leaves 15. Half of them will pass. Not a good ratio, is it? But Jonathan, you be the judge on this. If you had the sale, you had your speech,
That's okay.
or quantitative analysis. What math you have in class? Take those quantitative analysis, get it out of the way. quantitative technique, whatever. Okay, what we do on this one, folks? All right, you got sales and you got average accounts receivable. So 1.5 million divided by 100,000. What does that give you? 15? Does that give you 15? So your inventory turned over 15 times. Now divide 15 into 360 will give you your average days in sales. So 15 into 360 is how much? 30 what? 360 divided by 15 is what?
24.
It would be in the 20s, wouldn't it? Be 24?
Yes.
All right. Now you can do it that way or you can do it third way. Now, let me give you some homework. Read chapter 17, number 1, and do some exercises for me. Let's do one vertical analysis. Let's do 17.1. Exercise 17.1. And we're going to skip over to 7, 9. Okay. 1, 7, 9. These are exercises in chapter 17. 11, 13, 14. All right, try these little exercises. They're not long, but read the chapter. Some of you have 2 problems to work back in the other chapter. Okay, I just want to show you how easy this chapter is if you have that page, if you practice and you have that page of ratios. So let's call it a day, and I'll see you on Thursday. And I'll start broadcasting.